Hello friends, let us continue with our wonderful chapter AS15. So come to paragraph number 5, categories of employee benefits. As per this AS15, employee benefits will be divided into 4 categories. All the employee benefits will fit into one of these 4 categories only. They are called short-term employee benefits, long-term employee benefits, post-employment benefit and terminal benefit. So we are going to discuss all these benefits one by one and the accounting treatment also one by one. Some of the examples of short-term employee benefit. Just now immediately I will tell you short-term employee benefits are those benefits which fall due within 12 months from the balance sheet date, that is short term, and long term benefits are those benefits which fall due after 12 months from the balance sheet date. So within 12 months from balance sheet date we'll call it short term, after 12 months from the balance sheet date but before retirement we will call it long term benefit. And the benefits which falls due on or after retirement are called post employment benefit. Benefits which will fall due on or after retirement, we will call them post employment benefit. And there are sometimes situations where the employee either takes VRS, voluntary retirement scheme, or the employer terminates the services of the employee before the normal retirement. The employer asks the employee to leave, or the employee may take voluntary retirement. Then there are certain compensation paid to the employee. Those compensation are called termination compensation, like voluntary retirement expense. So those will be covered under the 4th category of employee benefits, which we are going to call termination benefits or terminal benefits. It is called terminal benefits or termination benefits. Okay. Some of the examples are written here. Example of short-term employee benefits: salary, wages, social security contribution, annual paid leave, that is paid vacation, paid leave, and medical or housing care. Some of the examples of long-term benefit: they will fall due after 12 months but before the retirement. Sabbatical leave, that is the employee may be given 6 months or 1 year of paid leave. He can go and study something or whatever he wants to do, that is sabbatical. That is for some period he will not work but the organization will pay. Some company may pay long service award. Those who will complete 25 years will be given some monetary or non-monetary awards, that is long service award, or there can be long term disability benefit. These are the examples of long term benefit. Post employment benefit example, most of you know, gratuity. Once the employee retires, then the employer pays him gratuity. Either gratuity will be paid as per the Payment of Gratuity Act, or the gratuity may be paid as per the contractual arrangement. After retirement, companies pay pension to their retired employees till their death, that is pension. Some companies pay even to the family members of the deceased for a certain time period, that is family pension plan, that is also covered. Some companies also provide medical care to the retired employees. Some of them provide housing facilities to the retired employees. So this will also be covered by post employment benefit. And then last but not the least, termination benefit. What is termination benefit? When the employee services are terminated before normal retirement, compensation is paid to him Example, retrenchment, employer reduces the number of employees. Or voluntary retirement, employee opts for voluntary retirement and he leaves the job before the normal retirement. So today our topic would be short-term employee benefits. How to identify whether a particular employee benefit is short-term or not. Wherever employee benefits are expected to be settled within 12 months from the reporting date. This is very important. Benefits are expected to be settled within 12 months from the reporting date. Within 12 months, if the reporting date is 31st March 2024 and if the benefits are expected to be settled on or before 31st March 2025, this is our balance sheet date, then such benefits will be known as short-term benefits. Such benefits are called short-term benefits. Then we have post-employment benefit. Right now we are only defining what are these terms. Post-employment benefits, as the name suggests, are expected to be settled on retirement, gratuities paid on retirement or post-retirement, that is after the retirement. Pension is paid after retirement, gratuity is paid on the retirement date. And then the third category is called long-term employee benefit. So these are the benefits which are expected to be settled beyond 12 months from the reporting date but before the retirement. After 12 months from the reporting date but before retirement. If the benefits are expected to be settled before 12 months, it is a short-term employee benefit. If the benefits are expected to be settled on or after retirement, it is a post-retirement benefit. So the employee remains in the service, but the benefits are expected to be settled beyond a period of 12 months from the balance sheet date. And then there is a termination benefit. When the employee takes voluntary retirement or the employer terminates the services of the employee, they are paid compensation. They are paid some compensation, like you have heard VRS expenses or VRS received by this person. Those are the compensation for terminating the services before the normal retirement. Okay, so the answer is yes. Very important chapter for your upcoming exam. Okay, very important chapter, must do it. Now I will just help you to understand one more time. Suppose my financial year is 1/4/2024, year ending date is 31st March 25. This is the beginning of financial year 24-25. This is year ending date. These lectures are very important for upcoming exam. Year ending date 31st March. 1 year from the year ending date, and then this is date of retirement. This is the timeline, date of retirement, which I am not writing, it can be any date. So now what you should do, you should mark if the benefit is falling due, expected to be settled within the 12 months from the balance sheet date. Such benefits will be short-term employee benefit. Okay, this is 12 months from balance sheet date. 12 months from balance sheet date. So up to 12 months from the balance sheet date, it is short-term employee benefit. If the benefit falls after the balance sheet date but before the retirement, then we will call long-term employee benefit. If the benefit falls on or after the date of retirement, then we will call it post-employment benefits. Interested students can note down. Then it is called post-employment benefits. then it is called post employment benefit. So I will again draw this portion is short term employee benefit during the year within 12 months. Then this portion after the 12 months from balance sheet but before retirement is long term employee benefit, and on or after retirement, that is called post employment benefits. So we have to learn the accounting of each of them one by one. So first, paragraph 10, our first employee benefit is short term employee benefit, and you have to understand the accounting treatment. It is very easy. It is similar to what they teach you in the 11th and 12th accounting classes, or maybe foundation course or basics of accounting. This is already known to us. Accounting treatment for short term employee benefit. First, check whether these benefits will be settled within 12 months from the reporting date. If the answer is yes, these are short term employee benefit. Since benefits are settled within 12 months from the reporting date, if the benefits are expected to be settled within 12 months from the reporting date, these are short term employee benefit. One important principle you will learn now, these are not required to be discounted. These are not required to be discounted means there is no need to calculate present value. There is no need to calculate present value. Take them as it is. Whatever is the amount due, account at the same amount. No need to do discounting. No need to do the discounting. You will take them at the same amount. If the amount due is 1 lakh rupees, record 1 lakh rupees. No need to compute the present value. Present value calculation will be required in this chapter if the benefits fall due more than 12 months from the balance sheet. So one simple rule keep in mind, if the benefits fall due within 12 months, no discounting. If the benefits fall due beyond 12 months from the balance sheet date, then discounting will be required. Some example of short term employee benefit. So if they ask you in the exam, write 4 examples of short term employee benefit, then you will write wages, salaries, social security contributions, which will fall due within 12 months. Remember, okay, in some country they provide such benefits. Then paid annual leave, paid sick leave, maternity leave. These are together called short term compensated absences. Short term compensated absences means the employee is paid even for those days when he is absent. That is called paid leave. That is paid leave. If they fall due within 12 months, then they are called short term employee benefit. But if they fall due or are expected to be settled beyond 12 months, then they are called long term employee benefits. Then the third is profit sharing and bonus, where the employee gets a certain percentage of profit as bonus. If it is payable within 12 months from the end of the balance sheet date, it is short term. If it is payable after 12 months from the balance sheet date, it is long term. And I have told you, this also includes perquisites, non-monetary benefits. So like medical care, housing, car, free or subsidized goods or services for the current employees. These are some of the example of short-term employee benefits. Now come to the accounting part. You have already studied accounting of salaries and wages in your 11th and 12th standard, and the good part is that the same accounting continues here. Now whenever you make the payment for the short-term employee benefit, what entry do you pass? You pass the entry, let us write employee benefits. I am not writing salary or wages, it can be any short term benefit. So when you make the payment, you pass this entry, employee benefits account debit to bank account, employee benefit account debit to bank account, amount paid. Now at the end of the year, what I'll do, I will see whether the amount paid is less than the amount accrued. If the amount paid is less than amount accrued, then we are going to also provide for wages or benefits payable. So I am going to pass an entry at the end of the year. I am going to pass an entry at the end of the year. If the amount is payable, that means you have not paid full amount. You have to pay 2 lakh rupees. You have paid only 1,80,000. So you have to pass entry for outstanding wages, outstanding salary. It is the same thing. Employee benefits account debit to provision for employee benefits. Or you can write to employee benefits outstanding. If you are comfortable with that, you can write to employee benefit outstanding. Second possibility is that you have paid more than what was accrued. Amount paid is more than amount accrued. You have to pay 2 lakh. You have paid 2,20,000. 20,000 is prepaid. So I am going to pass an entry if the amount paid is more than what it was accrued. In that case, I will pass the entry prepaid employee benefits, like your 12th standard teacher explains, prepaid employee benefit account debit. This will appear in the balance sheet as an asset to employee benefits account. Good students are writing, other students are watching as if they have come to some kind of concert. Okay, just watch, don't do anything. Prepaid employee benefit account debit to employee benefits account. They have not written such entries in your study material. How will you learn? So we have one employee benefits debit here, one employee benefits debit here, one employee benefit credit here. We will calculate what is the balance left in employee benefit account after all this entry, and then we will transfer it to P&L account. P&L account debit to employee benefits. This is usually the entry that we pass. One more thing I have to tell you, but wait, up to this you have understood. So employee benefit will be transferred to P&L account unless another accounting standards permit capitalization. Unless other accounting standard permits capitalization. Some accounting standards allow you to capitalize. Some accounting standard allow you to capitalize. Can you give me some example where some other accounting standard allows you to capitalize employee benefit cost? If you have studied other accounting standard which permit capitalization, example is accounting standard 10, property, plant and equipment. Accounting standard 26, intangible asset. So if an employee is involved in construction of a property, plant and equipment, then the salary paid to him is not transferred to P&L account, it is added to the cost of that property, plant and equipment. Similarly, if an employee is working in the development, okay, generation of some intangible asset like research scientist, their salary is not charged to P&L account, their salary is added to the intangible asset. So in that case, the salary or employee benefit would be capitalized over the cost of property, plant, equipment or intangible assets. To make your life easier, we have written a list of journal entries you will pass. Very important, journal entries that the companies have to pass for short-term employee benefit. One is when employees provide service and we make the payment. Entry for payment made to employees, employee benefit account debit to bank. At the end of the year, there may be some outstanding employee benefit, outstanding salary or outstanding wages. In that case, you will pass an entry, employee benefit account debit to provision for employee benefit, or you can write here employee benefits payable. If the amount paid is less than amount accrued, you will have to create a liability by passing an entry, employee benefits account debit to provision for employee benefit, or you can pass the entry to employee benefits payable account. Okay, and what you do, very important note here, very important note, in the subsequent year, in the next year, you are going to reverse the entry. In the subsequent year, you are going to reverse the entry. In subsequent period, payment will again be charged to employee benefit account, but the above provision will get eliminated with employee benefit. Okay, so in subsequent year, we are going to eliminate the provision account by reversing it. In the subsequent year, we are going to eliminate the opening provision by reversing it. So what is the entry in the subsequent year? In subsequent year, when you make the payment, you pass the entry employee benefit to bank as usual. The provision made in the earlier year is reversed or is eliminated. Entry will be provision for employee benefits to employee benefit. This is how practically the accounting is done. Whenever the provision is made at the end of the year, it is reversed in the next year, and then what will happen in the next year, you can add one more point. At the end of the year, fresh provision will be made. So based on the amount outstanding at the end of the subsequent year, fresh provision will be made. Again you will pass an entry, employee benefits account debit to provision for employee benefits. So this will repeat every year. So what is the amount that is actually charged to P&L account? Employee benefits paid plus, this is paid, point number A, plus outstanding at the end. You will add this third entry and minus outstanding at the beginning. Oh, is this the same thing your 12th standard teacher has taught you? Exactly the same thing. First you pass the entry for benefits paid, which appears in your trial balance as salary or wages. Then in your note, in your adjustment below, they used to give you salary outstanding is so and so amount. So you will add. So that is basically my third entry. And somewhere in the trial balance you were given opening outstanding salary. So that you used to deduct. That means the second entry. You are eliminating the opening outstanding figure. Provision for employee benefits to employee benefit. And this way the entries are actually passed. So I will repeat for you. Whenever the benefits are paid, employee benefits to bank. Whenever you have opening outstanding salary, you will reverse the entry by passing provision for employee benefit to employee benefit. So opening outstanding balance account is removed, and then at the end of the year again check how much is the outstanding employee benefit and create a provision for that. Employee benefit account debit to provision for employee benefit. So what will get charged to P&L account? The benefit paid plus benefit outstanding at the end minus benefit outstanding at the beginning. Okay. Then there are few notes below this. We are going to read those notes. Note: bonus and profit sharing plan are generally STEB. General discussion: bonus and profit sharing plan means the employee is paid a certain percentage of profit as bonus. Work hard, you will get 1% of net profit. So this will motivate the employee to work hard throughout the day, because he knows if the company makes more profit, he'll get some percentage of profit. Is it a short-term employee benefit or is it a long-term employee benefit? The answer depends on whether it is expected to be settled within 12 months from the balance sheet date. If it is expected to be settled within 12 months from the balance sheet date, we'll call it short-term employee benefit. Okay, and we are going to make a provision for bonus payable or profit sharing payable. Make a provision for that. So if the employer has committed to the employee that you will get a certain percentage of profit, make a provision for bonus payable if three conditions are satisfied. If three conditions are satisfied, then you will make a provision for bonus payable. What are these three conditions? First is the entity has present obligation. Present obligation means probability of liability, probability of obligation existing is more than 50%. So there is a high chance that this liability exists and the company will have to pay. Second condition is, you can put them as condition number 1, 2, 3. The second condition is that the settlement will result into outflow of resources. Whenever the entity will settle that liability, there will be an outflow of resources. The company will have to make payment in the form of cash or any other asset or any other compensation, which will result into outflow of resources from company to the employee. And the third condition is that it can be measured reliably. So once again, can we recognize bonus payable as provision at the end of the year? Yes, if three conditions are satisfied. 1, present obligation. 2, settlement will result into outflow of resources. And 3, a reliable estimate can be made. It can be measured reliably, because in order to make provision, in order to do accounting, you need to measure the liability reliably. If these three conditions are fulfilled, then you are able to make provision for bonus payable. Generally, management estimates it on the basis of past data. So how do you estimate? Based on your past history, you will be able to estimate the amount of provision required. Now we'll take one question number 3. Kindly pay attention. Entity X is required to pay salary of rupees 2 crore for the year 2001-2002. 2 crore rupees the salary, and the entity has actually paid 1.90 crore up to 31st March. So this 2 crore is the salary accrued. 2 crore. Salary actually paid is 1.9 crore. So salary outstanding is 0.10 crore. So you will have to make a provision for 0.10 crore. Determine the actual cost to be recognized in the year 2001 and 2, and any amount to be shown through balance sheet. So in the P&L account, employee benefit expense will appear at what amount? 2 crore, 1.9 crore. 0.10 crore. Choose the right option. In the P&L account, how much amount will you show as employee benefit expense? So the answer is 2 crore. And what about balance sheet? In balance sheet, liability side, under current liability, you are going to show provision for employee benefits. You are going to write provision for employee benefits 0.10 crore. So in the balance sheet, we are going to present 0.10 crore outstanding on the liability side under current liability, because it will be paid in the month of April, that is within 12 months from the balance sheet date. So it will be presented as current liability. Is it right? Check the answer in your book. Is it the same thing? Is it the same thing? Salary outstanding to be shown in the balance sheet 0.10 and employee benefit expense to be shown in P&L account as 2 crore. So your institute has given this answer, which is quite simple. Total expense 2 crore, amount to be shown in liability 10 lakhs. Next point is profit sharing and bonus plan. Already discussed with you that if the entity has promised to pay salary which is related to profit of the company, that is bonus is linked to the profit of the company, make provision if 3 conditions are satisfied. There is a present obligation, a reliable estimate of the obligation can be made. Okay, this obligation arise as a result of past event. Obligation arise as a result of past event. That means you have promised to pay bonus linked to profit. And one more thing you can add here, settlement will result into, please write, settlement will result into outflow of resources. Settlement will result into outflow of resources. Settlement will result into outflow of resources. So actually the question is, should we make provision for bonus if it is linked to profit sharing? The answer is yes, if 3 conditions are satisfied. It is a present obligation arising out of past event. Settlement will result into outflow of resources and a reliable estimate can be made. Okay, reliable estimate means there must be some formula agreed between the company and the employee that this is how the bonus will be calculated. For example, the bonus may be calculated as 1% of PBT. That is how the bonus provision will be made. Okay, and you have to make a provision for bonus payable. Entry would be, you can write the entry. So at the end of the reporting period, companies have to pass the entry, bonus expense account debit to provision for bonus. This bonus expense will be transferred to P&L account. Provision for bonus will be appearing in balance sheet current liability if it is a short term employee benefit. So that is how the bonus is treated in the books. Let us take a question on bonus. Question number 4, taken from your study material. A profit sharing plan requires an enterprise to pay a specific proportion of its net profit for their to employees who serve throughout the year. Bonus will be given, but only if you serve throughout the year. If no employees leave during the year, the total profit sharing payment for the year will be 3% of the net profit. If an employee works for entire 12 months, then the bonus will be 3% if no employees leave. So the total liability of the company would be 3% of net profit if none of the employees leave. The entity estimates that staff turnover will reduce the payment to 2.5% of the net profit. But as you know, human beings don't stay for a long period in one organization. Some or the other employees are going to leave. Therefore, finally, the bonus payable will come to only 2.5% of net profit, because those employees who would leave will not get bonus. Those employees who would leave will not get bonus, and therefore the company's bonus expense will be only 2.5% of the net profit. How much liability needs to be provided? So the company will have to make a provision equal to 2.5% of net profit, because that is what is expected to be paid to the employees. That is what is expected to be paid to the employees. So the answer for this question doesn't require much explanation. Not every employee will get the bonus. Those who will stay for 12 months will get the bonus. If everybody stays, then bonus liability is 3%. But because some employees are expected to leave or have left, my bonus liability will come to 2.5% of the net profit. Now we'll come to question number 5. One more practice for you. On 31st March 2021, ASF Limited has bonus scheme for employees based on performance. ASF Limited estimates 20,000 as bonus payable. Actual payment was 21,000 paid in April 2021. Past journal entries. Past journal entries. So I need to first explain. As on 31st March 2021, I will make a provision of 20,000 rupees, because that is what we estimated on that date. That is what we estimated on that date. So the entry will be, entry on 31st March will be employee benefits account debit 20,000 to provision for employee benefits, to provision for employee benefits 20,000. We will create a liability. You want to call it employee benefits payable, you can call it. Okay, these employee benefits will go to P&L account, and this will appear in balance sheet current liability. Then that year is over. Next year, in April 21, actual payment made was 21,000. So I'll pass the entry for payment. Employee benefits account debit to bank 21,000. Employee benefits account debit to bank 21,000, and the provision which we had made will be reversed. The provision which we have made in the last year will be reversed. So the entry now will be provision for employee benefits, provision for employee benefits debit 20,000. This entry we are reversing to employee benefits 20,000. So what is the net effect in the second year? Employee benefits, you have debited 21,000 and you have credited 20,000, so the net effect is 1,000, and that 1,000 is due to short provision. Short provision means your estimate has changed. You had estimated 20,000, but actual payment made was 21,000. This is called change in estimate, and change in estimate will be recorded in the next year. Nothing can be done. You have studied Accounting Standard 5, which deals with change in estimate. You have also studied AS 29, whose name is provision, contingent liability and contingent asset. So at the end of the year, if the actual information is not available, we will make provision, in this case 20,000, and the actual outcome can be different from the estimated outcome. So that is recognized in the subsequent year as a change in estimate. So this is how the accounting will be done. Again, in this second year, at the end of the year, they will again calculate the provision for bonus, and again they are going to pass the same entry. So this way the entries will repeat every year. I have written the answer in your book. Please check. First entry, employee benefits to provision. Second entry, in April, employee benefits to bank. And third entry is provision for employee benefits to employee benefits. You will reverse the opening provision. You will reverse the opening provision. That is how the accounting of provisions is done. If they have taught you in 12th standard, very good. Your teacher was really good. If they have not taught you, don't worry. Now you have to learn, because once you become CA, you will not do plus minus. Please, I cannot do that. You have to take a software like Tally, and you have to actually pass the journal entry exactly like what I am doing. Okay, opening provision will be reversed. Again at the end of the year, fresh provision will be made. Automatically the net effect that should go to P&L account will get transferred to profit and loss account. So that was my question on bonus. I have taken a question on bonus. I have taken efforts to get good questions from other books also, wherever your study material did not have a question on a certain point. Now we'll come to short-term compensated absences. Okay, what do you mean by short-term? That means these are expected to be settled within 12 months from the end of the reporting period. Employees are allowed what is called paid leave. The employee will not work on a certain date, but is still paid for that. Different companies have different policies. They are known by different name, like they are known as annual leave. They are known as annual leave. Some companies give casual leave. So some days in a year you can take casual leave, sick leave, maternity leave, etc. Paternity leave, not many companies will do that. Okay, that is paid leave. The policy is that they allow a certain number of leaves during a year. Certain number of leaves are allowed. In a year, certain number of paid leaves can be taken. That is how some companies do. And then there are different policies for unused leave. There are different policies for unused leave. Some company says you are allowed 12 days of paid leave in a year. You could not avail the leave. That is called unutilized leave. Some employees are very hard working. Even though they are allowed 12 days of leave, they don't take. Okay, they work. So what about the unutilized leave? The unutilized leave cannot be carried forward. One company says unutilized leave cannot be carried forward. So it will lapse. It will lapse. It is called lapse. No compensation will be given for unutilized leave. Either you take the leave. If you don't take the leave would lapse. It cannot be carried forward. And the second possibility that can be carried forward to the next year or subsequent year. That means if you don't avail leave in this year, you can utilize this leave in the next year. Next year you can take more leave. Suppose I have taken out of 12 6 leave only in this year. I can use this unutilized 6 leave in the next year. So next year I will be entitled to 6 plus 12, 18 days of leave. That is carried forward. Here also we can have two policies. Unutilized leave can be carried forward, okay, and you can encash it. If you don't want to take leave, you can encash it, or you can take leave but not in cash, but can't in cash. So let me just adjust the video. Okay, so I'll just first explain what is written there. An employer allows employees to take 12 days of leave in a year. There are different policies in different companies. Some company may say unutilized leave cannot be carried forward, it will lapse. You will only be paid for those leaves which you have taken. Another company may have a policy where unutilized leave can be carried forward, and then there also we can have two policies. Some companies will say unutilized leave will be encashed if you don't utilize it in the next 12 months. Some company says unutilized leave can be carried forward for one more year but cannot be encashed. So you can take leave in the subsequent year but you will not get cash for unutilized leave. But some companies are more generous. They say either you can take leave in the next year or you can utilize, So cash or leave, both are allowed. Only leave are allowed, nothing is allowed. So my accounting treatment will accordingly change. My calculation of the provision for unused leave will also change. Okay, so let us read the note now and you will understand. These paid leaves are called earned leave, sick leave, casual leave, privilege leave. Okay, some company call privilege leave. Some company give maternity leave to women, and some companies are more generous. They also give to the gentleman paternity leave to take care, okay, of the family. Whatever you call it, there are two types. Okay, there are two types. First, situation 1, student will pay attention. This is a little complex part, but once you understand it, it is easy. First is leave cannot be carried forward. If leave cannot be carried forward, they are called non-accumulating leave. Remember this term. If leave cannot be carried forward, either you utilize it in this year or it will lapse. They are called non-accumulating. The leave is not getting accumulated for future period. It will lapse. So what about the accounting treatment? No accounting treatment. No accounting treatment means no provision is required. Write down, no provision is required. The provision will be required only for the utilized leave. No provisions required for unutilized leave, because the company will not give you more leave, company will not pay you more cash. No provision is required for unutilized leave. No provision is required for unutilized leave, which means the company will have to pay only for utilized leave. Company has to pay only for utilized leave, but no provision is required for unutilized leave if leave cannot be carried forward or unutilized leave cannot be encashed. Okay, so basically the employee would be a loser here, because he will lose the amount of that unutilized leave, punishment for being hard worker, you can say. Second situation is leave can be carried forward. If not in this year, you can use in next year. Again, the student will take trouble to remember if leave can be carried forward to the next year or future period, we will call them accumulating leave. The leaves are getting accumulated. If not in this year, next year. If suppose 12 days of leave are allowed, you took only 6 days. Next year you will be allowed unutilized 6 plus 12 for the next year. So total leave you can avail in the next year would become 18 days. Okay, that these are called accumulating leave. Here also we have two cases. Case 1, the employee can either settle in cash or he can take leave. The unutilized leave can be settled in two ways. Either the employee can ask for cash or the employee can ask for additional leave in the next period. Then these are called vested leave. One more important point, they are called vested leave. From the employer's point of view, he has to make a provision for the entire amount of unutilized leave. Meaning, because out of 12 days, employee has taken 6 days of leave. Either he will get cash for these 6 days of unutilized leave or he will get leave for unutilized leave. In any case, I have to pay him. In any case, we have to make payment. If he takes leave, I'll make the payment. If he doesn't take leave, I have to make the payment. So I will have to make full provision for unutilized leave. So if the value of 6 days of service, suppose the value of 1 day is 10,000, value of 6 days of service will be equal to 60,000. You will have to make a provision for rupees 60,000 at the end of the year for the unutilized leave. So that is called vested leave. You will have to highlight vested leave, you have to highlight accumulated leave. If the employee cannot settle the unutilized leave in cash, but he can only take the leave in future period, then these are called non-vesting leave. Again highlight, non-vesting leave means only leave is allowed but cash is not allowed. Only leave is allowed but cash is not allowed. Now suppose the employee is entitled to 12 days of paid leave. He has taken only 6 days of leave in the current year. 6 days he can carry forward and utilize in the next year. How much provision will be made? He will not be given cash. So based on the past history, based on the experience, the management will have to make an estimate. What is the estimate required? That out of 6 days, how many days of leave this fellow is going to take? Suppose management estimates he will take only 5 days of leave out of 6 days that he will carry forward. So based on the expectation, this time I am going to make a provision of only 50,000. This time I am going to make a provision for only rupees 50,000 because I estimate that I will have to pay him 50,000 rupees. He will only use 5 days of leave. Then the student will have a question, what if he takes more than 5 days? What if he takes less than 5 days? That is called change in estimate, and it will automatically get adjusted in the profit and loss account. When we will transfer the employee benefit expense to P&L account, any additional amount paid or lower amount paid will get adjusted in the employee benefit expense, because every year at the beginning I am going to reverse the provision, every year end I am going to make the provision, and therefore the change in estimate will automatically get adjusted in the amount charged to profit and loss account. So don't worry about that. Is it right? Then I have made a small summary for carry forward leave. Students will pay attention. Follow this highlighter. Question is, can the compensated absences be carried forward? Can the unutilized leave be carried forward? If the answer is no, it is called non-accumulating. Recognize as expense when absence occurs. So only make provision for utilized leave. Do not make provision for unutilized leave. Okay. Again, can the compensated absences be carried forward? The answer is yes. Now here we have two possibilities. Accumulating, and under accumulating we have two possibilities, vesting and non-vesting. If the answer is yes, can be carried forward to be utilized in the next period, then again ask a question that are the employees who leave entitled to cash payment in respect of unutilized entitlement? That is, whether the employee will get cash for unutilized entitlement. Again there are two answers, yes and no. If the employee can carry forward the leave and is also entitled for cash entitlement, if he doesn't want to avail the leave, then make full provision for the unutilized leave. Make full provision for the unutilized leave, because either you will have to pay him cash or you have to pay him cash for unpaid leave, or if he takes the leave you have to pay him. In any case you have to compensate him. You have to compensate him by giving him a paid leave in future or giving him cash. Make full provision. But if the answer is employee is not entitled to cash, but the employee can only take the leave, then you will have to make an estimate as to how many employees will utilize the carry forward leave. If out of 100 employees only say 5 employees will utilize carried forward leave, then make provision only for 5 employees. If out of 6 days of carried forward leave only 5 days will be utilized by the employee, then make provision only for 5 days. So this will require estimation. Estimation can change. The effect of change in estimation will get reflected in your profit and loss statement automatically. Okay. Now there is a small exception here. There are 4 categories of entities for the purpose of applying accounting standards. Okay, there are 4 categories of entities for the purpose of applying accounting standards. So some exceptions are given to small and medium size company and micro and small and medium size enterprise, which are level 4, level 3, level 2 non-corporate entity. Because they are very small enterprise, for them it is very difficult to maintain records, hire a good accountant and do all this complex calculation, because this might involve some additional time, resource and cost. They may not comply with short-term absences. To the extent they deal with recognition and measurement of absences which are non-vesting, that is short-term accumulating compensated absences in respect of which employees are not entitled to cash payment of unused entitlement on leaving. Okay. So some exceptions are there for unvested leave, non-vested leave, because this will require lot of estimation. How much provision is to be made? For that you have to do the past data digging, analyze the past data, then identify how much provision you need to make. So for non-vesting compensated absences, the provisions are not applicable to non-corporate entities which are level 2, level 3 and level 4 entities. Only this exception for non-corporate entities which are level 2, 3, 4, and that too only for non-vested leave. Now back to back we are going to take some questions. Questions have been taken from your study material, past exam and some good reference book, so that there is a complete conceptual clarity, you get a holistic idea. If I take only one problem, probably you will not be able to fully grasp the concept. So by taking 2, 3, 4 different varieties of question, I will be able to generate interest in the current topic. So ready, steady, go for question number 6. AS Private Limited has a head count of 100 employees in 2000-2001. So there are 100 employees. As per the employee policy, employees are entitled to 30 casual leave. 30 casual leave, out of which 10 casual leave may be carried forward to the next year. 10 leave can be carried forward to the next year. And 10 sick leave, out of which 2 sick leave may be carried forward as paid leave. On 31st March 11, that is the year ending date, the average unused entitlement is 5 days per employee for privilege leave and 1 for sick leave. Is it right? Now there is a mistake. Anybody who has read the problem, here they are using the term casual leave, here they are using the term privilege leave. They are same. So unused entitlement is 5 days for privilege leave. Unused entitlement is 1 day for sick leave. On an average, it is found that number of such employees who would be claiming annual leave would be 30 and 10 employees who would be claiming sick leave. So there are 100 employees, but not everybody would be able to utilize the unused entitlement. Only 30 employees would be able to utilize the carried forward leave of 5 days. These are smart people. And 10 employees would be able to claim sick leave, which is carried forward is 1 day. Allowed is 2, but one has to see how much is carried forward. Only 1. These are the people who are going to avail the carried forward leave, who are going to utilize the carried forward leave. Compute the liability to be recognized for sick pay and privilege pay by the entity in 2010-11. Okay. So first thing you have to mention that these are accumulating leave. Accumulating leave because you can carry it forward. Second thing you note down, these are non-vesting leaves. These are non-vesting leaves. Only leave is allowed, cash is not allowed. Leave is allowed, cash is not allowed. Leave is allowed, but cash is not allowed. So therefore, estimate is required. Estimate is required. Estimate is required. Okay. Estimate is required for employees who would utilize estimate is required for employees who will utilize the unused leave. And finally, the answer is provision should be made equal to 30 into 5 plus 10 into 1, and that is equal to 160 days. Okay, 160 days. Actually they should have given amount also, so the provision will be 160 days multiplied by average salary per day if in your exam they also give you average salary per day, let us say 10,000 rupees, then in that case the provision will be equal to 160 multiplied by 10,000 rupees. That is the amount of provision. That is the amount of provision required. Okay, so that was my answer. The answer of the respective book is only so much. The entity will recognize liability in the books equal to 150 days of annual leave and 10 days of sick leave. But the good student, what they will do, they will also mention some basic information and then start completing the answer. Okay, so that is the sign of a good student. But who is a good student? That is a big challenge nowadays. Students are now the masters. Okay, come to question number 7. Question number 7 from your study material. Very, very important. An entity has 100 employees who are each entitled to 5 working days of paid sick leave for each year. Unused sick leave may be carried forward for 1 calendar year. Sick leave is first taken out of current year's entitlement. Very important line. Sick leave is first taken out of current year's entitlement. So if you have taken sick leave, it will be first adjusted against current year entitlement. Current year entitlement is 5 days, and then out of any balance brought forward from previous year. If you have taken more than 5 days of leave, then the excess will be adjusted against brought forward leave. So that is called LIFO basis. First adjustment will be made out of current year entitlement of 5 days. Any excess leave will be adjusted against brought forward leave. At 31st March 2001, the average unused entitlement is 2 days per employee. So they have not used 2 days. 2 days can be carried forward for 1 year. So this is an example of short-term compensated absences. Okay, it is an example of short-term compensated absences. Now next is, the entity expects, based on experience that is expected to continue, 92 employees take no more than 5 days of paid sick leave in 2001-2002. These 92 employees will take only 5 days of leave, which will be adjusted against current year entitlement. So their brought forward leave will lapse. They have got 2 days of leave brought forward, but it will lapse because the 5 days of leave which they are going to take in the second year will be first adjusted against the entitlement of second year only. Will be first adjusted against entitlement of second year only, and therefore with respect to 92 employees, the unused leaves will lapse. With respect to 92 employees, unused leave will lapse. Hence, no provision is required for 92 employees because I am not supposed to pay them. No provision is required for these 92 employees. They are very hard working, and that is the problem. They will not get benefit of unutilized leave. It will lapse. But what about the remaining 8 employees? And the remaining 8 employees will take on an average 6.5 days of leave. Oh, so they will take 6.5 days of leave. First 5 days will be adjusted against current year entitlement. Balance 1.5 will be adjusted against brought forward leave. balance 1.5 will be adjusted against brought forward leave. So these people are bit smart. At least out of 2 days they will be able to utilize 1.5 days. So provision will be required. Provision will be required for how many employees? Will be required for 8 employees. Provision will be required for 8 employees multiplied by 6.5 minus 5, that is 1.5, 12 days. Provision will be required for only 8 employees, which is equal to 12 days. Out of 6.5 days of leave, 5 days will be first adjusted out of current year entitlement. Then 1.5 days will be adjusted against previous year brought forward leave. So at the end of the first year, the company should make provision equal to 12 days, of course multiplied by average salary, which is not printed in the book. So the answer is, the entity expects that it will pay an additional 12 days of sick pay. How this 12 has come? 1.5 days for 8 employees as a result of unused entitlement which has accumulated at 31st March 2002. Therefore, make provision. Make provision means recognize a liability equal to 12 days of sick pay. Calculation I have explained. In case if you are interested, you can note down certain more lines. For writing a 5-mark answer, you need to put some extra effort than other students. Other student will only write 12 days. But you will write something more. If you write something more, you will also get something more in the exam. Write more, learn more, get more marks in the exam. What kind of plan is this? This is accumulating non-vesting leave. These are, you can also mention, this plan is accumulating, because you can carry forward non-vesting leave, but you can't in cash. You can only take the leave, non-vesting leave, as cash is not paid, as cash is not paid for unused leave. Cash is not paid for unused leave. So if they ask you what kind of plan is this? Accumulating. Vesting or non-vesting? Non-vesting. Why non-vesting? Cash cannot be paid for unutilized leave. Unutilized leave would lapse. Now we'll take a very good question, number 8. Now we'll take a very good question number 8. Write down very important question number 8. ASF Limited has 100 employees who are each entitled to 10 working days of paid sick leave. First you highlight 100 employees allowed to take 10 days of paid sick leave. Unused sick leave can be carried forward for 1 year. Sick leave is first taken out of current year's entitlement and then any balance brought forward from previous year. Same problem up to this point, but there is a difference. On 31st March, the average unused entitlement is 2 days. Circle this 2 days also. Based on past experience, management expects that only 20% of the employees will use 1 day from their carried forward leave. And this time they have given you salary per day also. So you will use salary per day for the purpose of estimating the amount. Compute the expense in respect of short-term compensated absences if they are assumed to be wasted. Short-term compensated absences, non-wasted short-term compensated absences. Very, very important, and you will understand the difference between wasted and non-wasted. Is it right? In case of wasted, if you don't utilize the leave, then you are going to get cash. So there are 100 employees and they have 2 days of unutilized leave. So if they take the leave, they will be paid for that, and if they don't take the leave, they will be given cash for that. Okay. Now they have said 20% of the employees will use 1 day. So they will get leave, and those who don't take the leave will get paid. So we'll have to make full provision. We'll have to make full provision for all the employees. So the answer would be provision required will be 100 employees into 2 days. 100 employees, 2 days. Either he will get cash or he will get leave. So because it's wasted leave, cash is also given for unutilized leave, and the amount is 2,500. So if you do the calculation, you will have to make a provision for 5 lakh rupees. In either case, you have to pay. Whether the employee gets the leave, pay. If he doesn't take the leave, then also we will have to pay him cash for the unutilized leave. Is it right? Next part, second part, non-vested. Non-vested means you have to estimate. Estimation is required. That is, only calculate provision for those employees who are expected to utilize the carry forward leave. So out of 100 employees, only 20% we are going to utilize, and how many days? Only 1 day. So we have to pay only 20 employees for 1 day. We have to pay only 20 employees for 1 day, and you multiply by 2,500. So that comes to rupees 50,000. So you can see the huge difference in terms of provision required. If it is wasted, you will have to make a provision of 5 lakh rupees, because everybody will either get leave or cash. But if it is non-vested, only 20 employees will be compensated for 1 day of paid leave. So most company would keep which type of plan? Vested or non-vested? Think and reply. Most companies would keep non-vested type of short-term compensated agreement with the employee, so that they don't have to pay cash. This is the answer of this very, very important question. If the student has not read this question, he might make a mistake. Okay. So this is about question number 8. One question I will dictate. One question I will dictate for journal entries. I request all the students to take out their notebook and write in the notebook. One question I have found from reference book for understanding purpose. I hope you will appreciate. Write down in the notebook. I will dictate the answer also. Mr. X had been given leave options as follows. Mr. X had been given leave options as follows. Five leave per month. 5 leave per month. Wow. In 1 month 5 leave are allowed. In 1 month 5 leave are allowed. I wish I can also work in such company. In the month of March 2015, so this is they are talking about March 15, Mr. X accumulated his leaves. Mr. X accumulated his leave. That means he did not take any leave. So he has 5 days of unutilized leave. and he can avail them in the month of April 2015. He can carry forward the leave and he can utilize it, and he can avail them in the month of April 2015. His monthly salary is rupees 30,000 per month. His monthly salary is rupees 50,000 per month. Is rupees 30,000 per month. Consider 30 days per month. Consider 30 days per month. Consider 30 days per month. Journalize in the following case. Journalize in the following case. Case 1. Mr. X is entitled to cash. So this is accumulating and vested leave. This is accumulating and vested leave. Make full provision. Case 2. Mr. X is not entitled to cash. Mr. X is not entitled to cash. Probability of availing leave is 80%. This is accumulating non-vesting leave. Accumulating but non-vesting leave, because you are not entitled to cash but you are entitled to take leave, and the problem says he is expected to avail only 80% of the carry forward leave. That means he is expected to avail only 5 into 80%, 4 days. So here I will make full provision in the first case. I will make full provision in the first case, but I am not going to make full provision in the second case. Make provision for only 4 days. Here we are going to make provision only for 4 days. So the question is, you have to pass journal entries. You have to pass journal entries. So write down in the notebook case 1. Case 1. Case 1, write down. Case 1. Journal entries. This is vested leave. Vested leaves means he can either get cash or he can get leave. That is vested leave. Vested leave. Journal entry. Date, particulars, debit, credit. He gets a salary of 30,000. Number of days in a month, 30 days. Salary per day is 1,000. He has carried forward 5 days of leave. He has carried forward 5 days of leave. So company will have to pay him 5,000 rupees. Either company will pay him cash or company will pay him for the leave utilized. So whenever he takes the leave, company will have to pay. If he doesn't take the leave, then also company will have to pay. So make full provision for 5 days of unused leave. 1 day is worth 1,000 rupees. Employee benefit account debit 5,000. Employee benefit account debit 5,000. 30,000 divided by 30 into 5. To employee benefits payable. To employee benefits payable. To employee benefits payable 5,000. You can use the term provision for employee benefits also. In some problem I had used provision for employee benefits. That is also okay. Narration, right? Being employee benefit expense recorded. 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 Now write down case 2. journal entries case 2. This is accumulating non-vesting. So we'll have to make estimate of number of days of leave that will be utilized in the next month. So write down, here I am going to multiply by 80%, 5 days into 80%, only 4 days, because we are expecting that this fellow will only use 4 days of unutilized leave. Date write down 31st March 2015. Employee benefit account debit 4,000. Employee benefit account debit 4,000. 30,000 divided by 30 days, 1,000 per day into 5 days into 80%. Not 5 days will be fully utilized. To employee benefits payable 4,000. To employee benefits payable 4,000. To employee benefits payable 4,000. So that was the answer of this question. That was the answer of the question. Okay, next year the provision is reversed. Just write a note. Next year the provision is reversed. Any difference between actual leave availed and estimated leave will be treated as change in estimate. Will be treated as change in estimate. Okay, will be treated as change in estimate and will automatically get adjusted and will automatically get adjusted in profit and loss account and will automatically get adjusted in profit and loss account. In profit and loss account, I will take amount paid plus closing provision minus opening provision. So if you have taken more leave or less leave, it will get adjusted in that amount paid. Is it right? And it will automatically get adjusted in the profit and loss account. Now question number 9, whether an entitlement to earned leave which can be carried forward for future period is a short-term employee benefit or a long-term employee benefit. So this is a long answer given by your institute. So whether earned leave is a short-term or a long-term employee benefit. So the answer is, if it is expected to be settled, if it is expected to be settled within 12 months from the balance sheet date, you can write if you want, it is short term. And if it is expected to be settled settled after 12 months from balance sheet date, it is long term. If it is expected to be settled within 12 months from the balance sheet date, we will call it short term. If it is expected to be settled after 12 months from the balance sheet date, we will call it long term. Okay. Question number 10. In case an enterprise allows, this is from study material, allows unutilized employee benefit like medical care, leave, travel, etc. to be carried forward, whether it is required to recognize a provision in respect of carried forward benefit. The answer is yes. If it is allowed to be carried forward, that means the employer has to pay in future. Okay, so provision is required. Provision is required because they are accumulating in nature. They are accumulating in nature. So depending upon the terms and condition, one has to calculate the amount of provision. That is not given in the problem. So according to the terms and condition of the employment, one has to estimate the amount and make provision. But provision is required because they are allowed to carry forward the unutilized benefits. Okay. In estimating the cost of such benefit, the probability of employee availing such benefit should also be considered. So all this you will read in the notes and write. This chapter has total 4 types of employee benefit. We have only completed right now short-term employee benefit. The next 2 types of employee benefits we are going to study together because most of the features are common. Like for example, these 2 which are quite common in terms of accounting is post-employment benefit and long-term employee benefit. So let us recollect the timeline we had drawn. This is balance sheet. This is 12 months from balance sheet. This is retirement date. Okay. So after 12 months from balance sheet and up to retirement date, we call it long-term employee benefit. After retirement till death, the benefits payable are called post-employment employee benefit. Post-employment benefit or post-employment employee benefit. In both cases, the benefits are due after 12 months. So one thing is common, we are going to use discounting. We are going to use discounting. Benefits will be paid after 12 months. So we are going to use discounting. Discounting will be required. Plus one more thing, because the benefits will be paid after a long period, lot of estimation will be done. Let us say you are the employee, okay, you are the happy employee, you have become a chartered accountant at the age of 24, age is 24 and the retirement date according to company policy, when you reach 62 year, you will retire. So you will retire after 38 years. You will retire after 38 years. Company will pay you gratuity. When you will retire on that day, company will pay you gratuity for your dedicated service, long service, which is equal to, let us say, for example, say 1% of last drawn salary into number of years of service rendered, into number of years of service rendered. 1% of last drawn salary into number of years of service rendered. Now my question is, how to estimate this last drawn salary after 38 years? What will be your salary? Can you estimate? No, you can't. It's not easy. And secondly, there is no certainty the person will serve up to 62. There is lot of employee turnover. Lot of people leave before completing the due date of retirement date period. Somebody may leave after 45, somebody may leave after 50. Okay, so it involves huge amount of estimation, and therefore to estimate the liability we take the help of an expert called actuary. We take the help of an expert called actuary. Have you ever heard actuary? Actuaries are experts, okay, specialist in statistics, estimations, okay. They are also professionals like chartered accountants, like cost accountants. They are also professionals, and to do that course also requires lot of hard work. They are experts in estimating the life, the cost, the medical cost, the housing cost that will be there after 20 years, 25 years. So one has to take the help of this actuary. They will do the calculation and they will tell you how much provision is required to be made. So our year ending date is 31st March 2024. The employee will retire on 31st March, let us say 2062, but he is rendering the service. Service is rendered. Service is rendered in this financial year. Payment will be made. Payment will be made after 38 years. So the liability has accrued because he has rendered the service. If he has rendered the service which entitles him to receive the benefit, I need to make a provision, but the payment will be made after a huge gap. It may be after 5 years also, 10 years also, 30 years also. Because the payment will be made after a long gap, more than 12 months, the standard says you need to compute present value. The liability will be based on present value calculation, because there is a huge difference between the date the liability has accrued and the date when the payment will be made. Time value of money is very important. Time value of money is very important here, and therefore we need to make the provision. So I have created some background for you. You are mentally prepared that what you are going to do now is not going to be as simple as you have learnt the short-term employee benefit accounting, because here we will have to do some discounting. As a student of accounts, we should know how these post-employment benefit liabilities are calculated. Just basic idea. Practically, companies take the help of actuaries, and this actuary actually tell them as to how much provision they need to make based on their calculations. But you are a student, you will be asked a question and you will have to do it. So first let us read the first point. What are post-employment benefit plan? These are those benefit plan other than termination benefit plan which are payable on or after retirement. Okay, termination benefits are discussed separately. Example of post-employment plan: gratuity, leave, salary, earned leave payment, if these are payable on or after retirement. Ex gratia, that is the amount paid voluntarily by the organization on retirement. Gratuity is amount paid due to legal or contractual requirement. Ex gratia may be voluntary. Settlement allowance, that is shifting allowance. from one place to other. The employee may have rendered service in one part of the country, but after retirement he would like to shift to settle in other part of the country. So some companies pay them settlement allowance also, so that he can carry his bag and baggage to other place with all those household item, that is settlement allowance. Some company may pay medical allowance, housing facility also, and pension. These are examples of post employment benefit. And what are long term employee benefit? We are going to discuss both of them together, because most of the accounting is same, except one difference which I will tell you later. Long term employee benefits are those benefits which are payable after 12 months from reporting date, but these are not post employment benefit plan, but before retirement. And these are not termination benefit plan also. Example we have already discussed in the beginning. Is it right? What are the types of post employment employee benefit plan? What are the types of long term employee benefit plan? For the purpose of accounting, very important, very important, write down, and on that you will have lot of questions. For the purpose of accounting and understanding, this post employment benefit plan, long term employee benefit plan are divided into two types. They are called defined benefit plan, defined benefit obligation plan, we will call in short DBO, or defined contribution plan, we will call it DCP. Post employment benefit plan for accounting purpose can be DCP or DBO, defined contribution plan or defined benefit obligation. Is it right? So today we'll stop here. If you want to know more about DCP and DBO, then come to the next lecture. So thank you very much, my dear friends. Please subscribe to our YouTube channel AS Foundation, and I request you one more time, share these videos with maximum number of your friends. All your friends who are in different level, whether they are giving first group, second group, give them this benefit of this lecture. Share in WhatsApp group, Telegram group, Facebook, or whatever you can do. This is the best thing that you will be doing for the benefit of your friends. If you want to purchase the accounting standard booklet, you can purchase from our office or our website vinod.in, or also available on amazon.in. Okay, you can purchase the entire video lecture of accounts, you can purchase the entire video lecture of financial management from our website vinod.in or from our office. Our books are also available on amazon.in. So purchase the books from amazon.in also if you are comfortable there. Thank you very much. See you tomorrow.